What's up, everyone? So my name is Ashwin, and this is going to be another video in my series about stocks and options trading. So in this video, I wanted to explain what option Greeks are in the simplest way possible. So Greeks are financial instruments that or metrics that allow you to measure the factors that affect the price of your option contract. These are available in every brokerage account, but I've seen that a lot of experienced traders even ignore these. So using a combination of the Greeks are a very easy way to assess the risk on any option trade. And I want to give you that advantage with this explanation. So with Greeks, there are 5 key Greeks that are used that are delta, theta, gamma, vega, and rho. But today we're going to cover the 3 most important ones that are delta, theta, and gamma. So let's get straight into the first one. So the first Greek that we have here is delta. So delta is a metric to estimate how much an option contract moves with a move in the underlying stock. So it's an estimate of how much the option value may change for every $1 move up or $1 move down in the underlying stock. It is represented from -1 to 1. So -1 for put options and 1 for call options are the 2 maximums. So for a contract, it could also be -100 to 100 depending on how brokers show it. So now let's go through delta with an example that I have here on the screen. So I'm showing you deltas here for call options on a stock that's currently trading at $170. The delta values here are on the right. If you notice the delta values, the further you go out of the money, the lower the deltas get. And the further you go in the money, the deltas get higher. So over here, you see how the delta decreases as you go further out of the money. So delta, of course, varies as the value of the stock changes. So let's say we're planning on buying the 185 strike call option for the stock currently trading at $170. You see that the delta here is 65. So that means for every $1 move in the stock, the option contract, which represents 100 shares, moves by $65. So if you look at the deltas of the strike prices that are more than $10 in the money, the deltas are close to 100. So that meaning your option contract, if you buy those strikes, will move as much as the underlying stock price. So the delta is a measure to assess how far out of the money you can go to buy an option. So the next Greek that we have here is theta. Theta is a metric to measure time decay. So options are a function of time, and options reduce in value as they get closer to the expiration date. That is called decay. As an option gets closer to expiration, the decay accelerates and the premium goes to 0 at expiration if the contract is not in the money. So theta can have values from 0 to -1. It can be above that also, and that is considered very high theta. The higher the theta is, the faster your option contract decays, meaning the premium reduces faster. So now let me take you guys through an example of how to use theta in your option trading decisions. So here's my favorite stock again that's trading at $170. I'm looking at options 5 days from expiry. I've shown negative numbers here, but ignore the negative sign for the time being. The higher the value of the theta, the higher the decay. The theta gets higher as we go further away from the money, and the theta values will be much lower if we're looking at a contract that is more than 30 days from expiry. So the further out from expiry we are, the lower the theta number will be. The closer to expiry we are, the higher the theta will be. So your options decay faster when they're closer to expiry, and they decay a lot slower when they're further from expiration. So the third option Greek that we're going to be covering today is called gamma, and it's a slightly tougher topic to understand. But one thing you guys may have heard about gamma are gamma squeezes. So gamma squeezes are when a stock moves up rapidly due to a large volume of out of the money call options, forcing the option sellers to then subsequently buy the stock. And short covering at that time fuels that fire. So this is very simple. This is exactly what happened in 2021 that allowed meme stocks like GameStop and AMC to go up so much. But now let's get back into the main definition of gamma. So gamma is the rate of change of the delta of a stock option contract. So how much the delta moves with a $1 underlying move in the stock. So gamma is low when the stock is far out of the money, but gamma increases as the option gets closer to the money. So for a stock with a delta of 50, and let's say it has a gamma of 10, a $1 move in the stock will move the delta to 60. So how is gamma used? Since an option's delta measure is only valid for a short period of time, gamma gives traders a more precise picture of how an option's delta will change over time as the underlying stock's price changes. So these were pretty much the three most important Greeks. There is another Greek called Vega, which is options price sensitivity to changes in the volatility of the underlying stock. Volatility is the rate of change of the underlying stock. And then there's one more Greek called Rho, which is the sensitivity of an option to the interest rate change. But these two are, especially Rho, is not something that we would consider in short-term trades. So I think when trading, the only three ones you need are the main three that we covered: delta, gamma, and theta. But these two, Vega and Rho, it's a good thing to maybe understand them, but they're not that important for trading. Alright, so that brings us to the end of this video. If you enjoyed the video, please make sure to like it and subscribe to the channel. I'll post another video sometime next week. A lot of big stuff coming soon, and stay tuned for that.